Give us your sense of how the markets interpreted what they heard from Jay Powell this week.
Oh, it was game on. So what they heard was, hey, the macro backdrop is hotter than we expected on a growth and inflation side, but we're going to keep the same accommodation we had before. So the only thing that's going to change are equity prices, and they're going to move higher. What that was is, to a lot of investors, I need to put on risk. I'm not going to be penalized for risk, so I'm going to put more risk on. I probably won't be penalized for leverage, so I'm going to put more leverage on. And things got, we had a pretty healthy move, let's just say that. So.
One of the things that I find surprising is at the beginning of the year, we expected something like 6 rate cuts this week. We've gone from 6 to 3. Some people think it might be less than that. And yet the equity markets didn't really discount to that. And why is that?
So I agree with that. And that's something we've been talking about. But there's more than one equity market. So higher rates did affect smaller caps, it affected value, and it held those back. But when you look at the S&P 500, the S&P 500 is really a growth index. And growth has just been lackluster. And the fact that you're actually pulling it back to an odd degree actually helps, because you're not accelerating the economy. You're keeping the economy right where it is, which is perfect for growth stocks. And the last thing I would say is that you have this amazing secular growth story in AI that's not going anywhere fast.
Well, that's exactly what I was going to ask about, because it's great we have AI, at least for the moment. We hope it's all going to prove out as brilliantly as people think it is. But is there a risk there in the narrowness of the market, because it's so tied into high tech and AI?
There is a risk to it, right? We don't like to see the market this narrow, but it does make sense, right? When we see a market that's a bit broader, typically we see different things. We see an economy that's moving from contraction to expansion. We're pretty much in this, what I would call economic malaise, where things aren't great, but they're not terrible. And you should expect a pretty narrow market. And again, the real story here, and I don't want to be too repetitive with it, is this secular growth story that's in play, and the fact that the Fed is adding a significant amount of accommodation to a period or a situation that really doesn't need it.
So you like momentum.
We do. We do.
Quite a bit. Explain that to us. What do you like in this picture that really tells you momentum is the way to go?
So it's not, what do we really like about it? Because the market's so narrow, because there's not a ton of opportunities, everyone's chasing the same names. And so what happens is you get stocks that do well continue to do well. And people say, well, Chris, that's kind of a silly way to invest, and it's kind of naive, and I understand that. But if you look at the fundamentals for the stocks that are doing very well, the fundamentals are actually quite good. And what we keep saying is people are very scared about momentum, because momentum, if you go back to post-financial crisis, say March of '09, momentum factors turned on their head, and people lost a lot of money playing momentum. Same thing with the pandemic. But what we're saying right here, right now, a lot of the macro factors that would cause a point of inflection just aren't there, be it credit spreads, be it the economy going from contraction to expansion, or the fact that the contrarian basket or a lot of broken stocks just don't have very good valuations and good fundamentals.
So momentum's good. Tell me about valuation. At what point are they fully valued? And tie that back in, if you would, to earnings. What we're expecting out of earnings, because that could take care of the valuation problem.
So, David, what I would say is that we don't have, I talk a lot about valuation, but our clients aren't talking about valuation all that much. And I understand why. We're in a chart looks good, relative growth type market. And so if growth is going higher, you're going to be rewarded by that. At some point, valuation will matter, but because growth is moving so quickly for a select number of stocks, there's really just one game in town, and that will continue for a while. What I think, and what you have to worry about with the rotation or broadening out in the market, is will the economy accelerate faster than we expect, and that could cause a rotation, and we just don't see that right now.
One last one. We have another game in town coming up in November. It's called an election. Do we take that into account at all as we take a look at investing in the stock market right now?
We do. I don't know how to handicap the presidential election, and luckily I don't have to. The real game in town here is the Senate. Who wins the Senate? And it looks like the GOP has a better than a 50-50 chance at winning the Senate. Why is this important? This is important because this could change the regulatory environment. The M&A market is improving, and if the GOP does take the Senate, we would expect an acceleration of the M&A market later on in the year because of the potential change with regulation.
So you think the antitrust enforcement policies of the Biden administration have held back some M&A? That's part of the reason we've seen its suppression?
Absolutely. There's not a question. It has absolutely held back some M&A.
Last one, taxes, because there's a question we're renewing the Trump tax cuts. How important is that in the Senate?
It's important, but it's not something a lot of people are talking to us right now. So I think it's more of a 25, 26 issue. It's not really a big issue and top of mind for many investors at this point in time.